The yen trade is back, and right now, we are sitting at the most dangerous price point in the entire currency market. I need you to look at 159.17 and understand that we are only 30 pips away from a breakout that could trigger a parabolic yen collapse, or an intervention trap that crushes late longs in a single hour. This is not normal price action. This is a structural pressure cooker. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use now. This is your instant market verdict. The session bias is undeniably bullish trending. Across every single time frame you can pull up, the 1H, the 5H, the daily, the weekly, even the monthly, the signal is strong buy. The moving averages are stacked in perfect bullish alignment, the MACD is positive, and the price is grinding higher with the persistence of a carry trade that refuses to die. However, the invalidation level that proves this entire bullish structure wrong is 158.28. Write this number down. If we break and close below 158.28 on the 4-hour chart today, the whole short-term momentum shifts, and the intervention ghost suddenly gets real. You need to pin 158.28 to your screen. That is the floor that holds the trend together. Now let's walk down the timeframes, because this is where the real story lives. On the monthly chart, US dollar to Japanese yen is a juggernaut. We have ripped through every moving average like they are not even there. The 200-month moving average is a distant memory below 140. The strong buy signal on this timeframe is relentless, and it tells you the multi-decade trend is higher as long as the Bank of Japan remains trapped in a yield curve control prison while the Federal Reserve keeps rates elevated. The weekly chart reinforces this with another strong buy reading, and I want you to look at the 200-week moving average sitting up at 155.58. The price is trading more than 350 pips above that level, which tells you that the long-term momentum is so stretched that any pullback to that average would actually be a buying opportunity for institutions. The daily chart paints the same picture. Strong buy, price above the MA200 at 157.26 and the MA100 at 157.26, which is functioning as a coiled spring of support. But here's what most traders miss. The daily RSI is only at 56. It's not overbought. That means this rally has room to breathe before we hit exhaustion levels. The MACD on the daily is positive at 0.110, no divergence, just steady upward thrust. Now drop to the 4-hour and the 1-hour execution charts. The 1-hour trend is strong buy, price is hovering around 159.17, and we have a very tight moving average cluster. The MA5 is 158.89. The MA10 is 158.61, the MA20 is 158.45, and the MA50 is 158.26. Notice how beautifully these averages are stacking. Short-term averages above medium-term, all sloping higher. This is a textbook bullish staircase. The key support numbers for today's active session are 158.58 and 158.28. These are the levels where intraday buyers have been reloading. And the resistance levels above us are 159.48 and 159.78. 159.48 is the immediate breakout trigger. That is where the market has repeatedly stalled, and if we close a 1-hour candle above that number, we are very likely to see an acceleration toward 159.78 and then a psychological vacuum toward 160.50. But here is the trap. Every breakout attempt in the past 2 weeks has been met with mysterious, aggressive selling that smells like Tokyo's rate checks and verbal warnings. So while the technicals scream breakout, the intervention ghost is sitting right on that 159.48 line, waiting to ambush over-leveraged longs. This is the cross-asset tension that makes US dollar to Japanese yen the most electrifying trade right now. And this ties directly into the Nikkei 225. When US dollar to Japanese yen rips higher, the Nikkei feeds on the weak yen, because exporters' earnings get a monster boost. Today the Nikkei is validating the move, pressing against its own highs. Risk sentiment is being shaped entirely by this yen dynamic. If 159.48 breaks and the Nikkei surges alongside it, The correlation confirms a full risk-on yen carry avalanche. But if Tokyo steps in and smashes US dollar to Japanese yen down through 158.28, watch the Nikkei reverse hard and take risk sentiment with it. This mutual validation is your embedded crosscheck. Let's connect this to the fundamental driver that just dropped. The 24-hour core news is that Japan's trade balance rose in April as strong exports offset rising imports. Why does this matter? Because a stronger trade surplus gives the Japanese economy a buffer, but more importantly, it does absolutely nothing to stop the carry trade. Exporters bring home foreign currency and often delay conversion, keeping dollars offshore. That dynamic actually adds to yen weakness in the short term. Meanwhile, the yield differential between US 10-year treasuries and Japanese government bonds remains a chasm. The Federal Reserve is in no hurry to cut, and the BoJ is terrified of tightening too fast and crushing the recovery. This yield gap is the engine of the yen trade. The article making the round says it perfectly. The yen trade is back, and it's reshaping global markets. Capital is flooding out of yen and into high-yielding assets globally, which lifts everything from the S&P to Bitcoin, but most directly it fires US dollar to Japanese yen higher. My 1 to 2 week directional lean is bullish, targeting 160.50 and possibly 162 if intervention remains only verbal. But the event that would invalidate this thesis completely is a confirmed, aggressive BoJ rate check followed by a massive spot intervention that drives the pair below 157.00 on a closing basis. If that happens, the carry unwind would be violent. But for now, the path of least resistance is up, until 159.48 proves otherwise. Now, most people will skip this next section, but this is where money is made. Keep watching. We are going into 3 precise trade setups. For today's session, Strategy 1, the sniper, the conservative play. This setup waits for the breakout confirmation that removes the intervention trap risk. The trigger condition is a decisive 1-hour candle close above 159.48, confirmed by the next 15-minute candle holding above that level. Entry goes long at a pullback to 159.48 itself, treating former resistance as new support. Stop loss is placed at 158.95, just below the MA20 on the 1 hour, protecting about 53 pips of risk. The logic is that a false breakout would quickly reverse below the short-term moving average cluster. Target 1 is 159.78, giving a risk-reward ratio of roughly 0.56. Not attractive on its own, but the sniper doesn't chase, they add. After target 1 is hit, move stop to break even and hold the remainder for target 2 at 160.50, which gives a total risk-reward of about 1.9. This setup is voided if the 1-hour candle close above 159.48 is immediately rejected and the next candle closes back below 158.58. That would signal a bull trap and intervention fear spiking. Strategy 2, the active trader, the standard approach. This one exploits the bullish moving average staircase without waiting for the breakout. The entry condition is a pullback to the 158.58 support zone, with a bullish rejection candle on the 15-minute chart, think a hammer or a bullish engulfing. The stop loss is placed at 158.20, just beneath the 158.28 invalidation level and the MA50 on the 1 hour. That's about 38 pips of risk. The logic is that as long as the price stays above the strong buy cluster, the trend is your tailwind. Target 1 is 159.17, the current price area, for a quick 1 minute and 1.5 seconds risk-reward scalp. Once target 1 is hit, move the stop to entry and let the rest run to target 2 at 159.48. If the price rips through 159.48, use a trailing stop of 20 pips to capture the breakout extension. This method lets you ride the momentum without getting chopped by the intervention whipsaws. Let's see how aligned we are. Type your US dollar to Japanese yen range for tomorrow in the comments now. I'm reading them. And if you think Tokyo steps in this week, drop a BoJ trap in the chat. Strategy 3, the aggressor, high risk, for those who know how to lose small and manage risk aggressively. This is the momentum chase on a smaller timeframe extreme. designed to catch a rapid surge above 159.48 before the intervention narrative kicks in. Entry is a market buy on a 5-minute close above 159.48 with volume spike confirmation. The stop loss is extremely tight at 159.18, just below the pre-breakout consolidation low, risking 30 pips. Target 1 is 159.78 and target 2 is 160.20. The risk-reward on this is asymmetric if the breakout is clean, but the probability of a whipsaw is high. This setup is only valid during high liquidity London or US overlap. If Tokyo is active, any sudden verbal intervention headline will shred this trade in seconds. You must be flat before the Asian close to avoid the BoJ trap window. Explicit warning: only take this if you can accept a 30-pip loss without emotional damage and are willing to re-enter if stopped out on a false break. Now the risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news, and stops are non-negotiable. With US dollar to Japanese yen, you are trading a pair that can move 100 pips on a single BoJ headline. Position size accordingly. Here is your session summary. The one most critical level for the next session is 159.48. A 1-hour close above it opens the floodgates to 160.50. A rejection and a break below 158.28 opens the intervention trapdoor. Tomorrow's focus will be any BoJ official comments or US durable goods data that could shift the yield differential. If Tokyo stays silent, the pressure cooker keeps building. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Check the end screen. The correlation fracture between risk assets is deepening, and you need that map. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage of all 8 assets. I'll see you in the next one.